Are we witnessing the fall of China's financial system? Stay tuned. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, China's banks are bleeding cash and fast. A liquidity crisis is spreading that could topple their entire financial system and quickly spread to the rest of the world. And if you think what's happening in China right now is bad, just wait till you see the shocking correlation to what's happening in the U.S. economy right now. And plus, while the market spirals and retail investors fear the worst, our trading strategies are thriving like never before. Keep watching till the end of the show to learn how our subscribers are cashing in and how you too can cash in big. Now, let's head over to Bloomberg, where he picked today's story up with a headline, as China's yuan effort pushes bank funding rate to 8-month high. And what we're seeing is China's banks are running out of cash. And this is a major problem because the first thing that happens when you go into a liquidity crisis are banks run out of cash and start to hoard what they do have, and then next thing you know, the entire system spirals out of control and in a rapid way, and you can see that happening right now in China. These signals warning of an onshore cash crunch added pressure on the PBOC, which has prioritized foreign exchange stability over easing policy. Now, this is very interesting because the move they should be making right now, and I'm going to show you in a chart that they should be easing policy. That's exactly the move the PBOC should be making. But instead, they're worried about defending the currency. That's something I don't think they should be doing. I'll show you why. Financial institutions have been hammered by elevated funding costs since January amid the central bank's restraint in liquidity operations, delayed policy easing, and the halt of the PBOC's bond buying. Now, if you're not familiar with what funding costs are, that's a cost of capital. Now, banks need money to run, and there's a cost for them to attract and get that money. Now, the problem is when the cost starts to rise, but demand for bank services is in decline, well, what you have is an issue where you have a liquidity crisis because banks need to take the money they get and turn it into a profit mechanism. Think of this from a small business perspective. Imagine the goods that you buy and to sell to your customers are going up in price, and at the same time your sales are going down. At some point you need a cash injection. That's the issue with Chinese banks right now. They're running out of cash. The money they do have they want to hold on to, and the government is looking to stuff massive amounts of cash into the system. And here we see that all these measures were designed to prevent the yuan from weakening amid expectations that the U.S. will enact more tariffs on exports from China. And we should find out more about that this coming week, as President Trump says he is likely to impose another 10% tariff onto China. But let's talk about this cost of capital and why the PBOC should be easing. Let's take a look at some U.S. data here. We have the commercial industrial lending data. This is shown on a year-over-year rate of change against the federal funds effective rate. Now, what I want you to see is that as commercial industrial lending decelerates, we'll go back to the late 1980s and then contracts when it heads underneath that horizontal black line. What is the policy move by the Fed? It's to lower interest rates. Now, if you think about it, it makes perfect sense. If demand for loans is going down, what do? You lower interest rates. It's the same thing for a small business. If the demand for your goods and services is not where you want it to be, if it's declining, what's something you can do? Lower the price to attract demand. So the policy move the PBOC should be making here is they should be lowering rates, but instead they're not. And we can look forward right into the dot-com bubble. What happens? You see a deceleration in bank lending, an ultimate contraction. The Fed is aggressively cutting rates. And then we move to the global financial crisis, where the Fed's starting to cut ahead of a slowdown in bank lending. But once the crisis hit, it comes crashing down into a massive contraction, the Fed all the way back to zero. And look where we're at now. What we see is bank lending here in the U.S. is hovering just above the neutral line, and the Fed now is moving into a position where they think they need to be on pause. But it would make perfect sense of why the Fed needs to cut, why the PBOC needs to cut. Because if the Fed cuts rates to stimulate demand for lending, well, that's exactly how money's created in the economy, is through new loans from the commercial banking system. So when you start putting the whole picture together, the PBOC is making an absolutely horrible move here. And with MLF loans unavailable till next offering in late March, funding may remain restricted unless central bank expands its cash offerings. And we've seen that. We talked about this last week, how the Chinese government is stuffing the banks full of money, and good reason why. They're in desperate need for it because their funding costs are rising, money's leaving the financial system, and all this is doing is setting up the Chinese banks for a massive liquidity crisis. Now, I have a question for you. I think that China is going to be the epicenter of the next global financial crisis. Do you agree with me? And if you do, hit that thumbs up in the bottom right of your video and vote. Now, if you don't agree, or you think it's going to be somewhere else, or perhaps you think Janet Yellen, former Fed chair, said, we'll never see another crisis in our lifetime. If you follow those lines, well, weigh in the comments. I'd like to know where you think the next crisis is going to center, or if we're even going to have one. Because liquidity is tight, and while NCD maturities are heavy for months to come, without active PBOC injections, funding pressure is likely to stay. So what the banking system is telling the government is, look, the situation right now is bad. We're desperate for cash. And if you don't keep putting money in the system, we're going to have an all-out liquidity crisis. And one of the problems is the global financial system is interconnected. So if the Chinese banking system starts to implode, it's going to rapidly spread all over the world. And we can see it right in the repo market, as China's repo market hit hard as yuan defense sparks cash squeeze. Now, if you're not familiar with the repo market, what the repo market is where people that have cash, this would be typically banks, lend that cash to other people who are desperate in need of it for very short-term loans. So you think loans that may be for a couple days or even a week. And granted, this is not big money for the banks, but what it does is they use their excess cash to fund these repo markets. And one way you can tell that the financial system is drying up is that when repo markets dry up, because that means those that do have cash don't want to lend it out. And the latest sign of a cash crunch at Chinese banks is a sharp drop in their lending through the repurchase contracts, or repo. The country's biggest bank cut their lending in the repo market by around 2/3 mid-February, compared with the daily average last year. So all of a sudden, you see that not only is money leaving the financial system there in a big way, what money the banks do have, they're trying to hold on to it because they're afraid if they lend it out in the repo market, and again, these are very short-term loans, that they might not get it back. There's something going on in the financial system there where banks are hoarding money. That means they're not likely to lend. This is a dangerous scenario because you can see it's all setting up a massive liquidity crisis. But one thing that shouldn't have a cash crunch, that's your trading account. Check this out. Our latest big trade as of close of business Friday, now up over 5% for our subscribers. Again, we put it right in the notes below. Now, if you want to cash in big on market cycles, grab the links in the description below. Be sure to use the free coupon code and join our trading system. Stay tuned to the end of the show, and I'll give you more details on how our subscribers are winning big, and you can too. Because if banks' cash borrowing pressure keeps building and the costs further climb, it may limit their ability to issue loans and support the economy. We doubt tightness in funding can be sustained for a long period, and that makes perfect sense. Banks, their operation, if you think about what they do, is their whole point is not only to hold money for people, it's to lend money out into the financial system. So banks are worried about money, and they're trying to hold on to the money they do have because it's being drained out of the system. They're not going to lend. And again, you come back to exactly how the financial system is designed. New money is created when commercial banks lend. It's destroyed when the principal value of those loans are paid off. So you can see the issue here, and the banks are very clearly telling the Chinese government this cannot go on for much longer, because if it does, we're all going to blow up into a massive liquidity crisis. And China's local government bond rush worsens the liquidity strain. So on top of this, the government's making matters worse by borrowing a lot of money out of the economy. This is ridiculous, I know, but check this out. The unusually big offering has exacerbated a cash squeeze this year as banks rush to absorb the securities. Money market rates have surged recently as the People's Bank of China refrained from monetary easing and kept liquidity conditions tight in an effort to support the yuan. So again, we come back to what should the PBOC be doing? They should be easing. They should be lowering interest rates. Instead, what are you seeing at the regional government level? They're out borrowing a whole bunch of money. So they're trying to compete with the banks for what little cash is in the system. You can see this is an entirely dangerous setup. And I want you to understand that these central bankers are making all the wrong moves at the wrong time. Because look at the factory activity. Now you'll see the headline says it returns to expansion, but trade risks grow. Well, not much of an expansion. The official manufacturing purchasing managers index was 50.2 versus 49.1 in January. Now keep in mind, 50 is unchanged from the month before. So what you're seeing is stall speed of 50.2. Now it's important to understand manufacturers, they borrow lots of money from the commercial banks. And again, that's how money is created. So if we're looking to see economic growth in China that's going to stimulate bank lending, well, you're not going to see it here at all. And even the non-manufacturing or services measure of activity in construction and services rose to 50.4 from 50.2 last month, again indicating stall speed for the entire Chinese economy. Let's take a look at why the manufacturing sector is absolutely critical to the banks. As we take a look again at U.S. data here, we have manufacturers' new orders with durable goods in red against commercial industrial lending in blue, again, both on a year-over-year rate of change. And you can see that slowdowns in new order growth lead to slowdowns in bank lending. Now, it makes perfect sense because a lot of businesses cannot finance their purchase orders. They don't have the cash. So they get an order in, they go to the bank and say, hey, we'd like to borrow money against this purchase order so we can buy the raw materials and we can manufacture it. Banks are more than happy to do that, and so that's why you see that when the economy is expanding and order growth is growing, that you get an expansion in bank lending. But when the opposite is happening, well, you get exactly what's going on right now, and you can see what it usually leads to, because back in 1995, we had what was considered a soft landing as the economy slowed down. How about we move forward right around 2000? What do we see? A slowdown in manufacturers' durable goods leads to a slowdown in bank lending, ultimately a contraction and a recession. You get a global financial crisis when you have a massive decline in bank lending, because again, it means money is being destroyed from the financial system, not something you need in a debt-based economy. In fact, you want the exact opposite if you want to see growth. And how about we move forward to 2012 when we almost saw a double-dip recession? You can see new order growth slowed, and that translated into less demand for lending. You see it happen once again going into the pandemic, and look where we're at now. You can see new orders in contraction, bank lending just over the zero line there, but the question is for how much longer before the U.S. financial system is destroying money and sending us into the next recession. Because the Trump administration has taken aim at China with a series of moves involving investment, trade, and other issues, and more recently threatened an additional 10% tariff that would take effect on March 4th. So if you think about the Chinese economy and its chance to turn around here, well, the odds are there's going to be less demand for Chinese goods when they're hit with another 10% tariff. So you think about their manufacturing sector, this install speed, and keep in mind, as the world's largest exporter, they need their manufacturing sector to drive the economy. So with more tariffs, that PMI number is likely to head under 50. And the value of new home sales from the 100 biggest property companies rose 1.2% to $188 billion as China's trying to put a floor under the real estate market meltdown that's weighed on its economy for more than 3 years. So again, another way to spur lending is to get your real estate sector going. The problem is it's not going anywhere. That's the problem. 1.2% year-on-year growth is absolutely nothing. But I want you to see what these property developers are doing, why they're putting banks and even to a worse financial system. Because you remember a lot long ago, we talked about how China came out and told the banks, you've got to lend to these property developers. And now look what they're doing. The China developers buy land at 20% premium in a bet on market bottom. So they're overpaying for land at a time when their economy is headed squarely into a recession. This is absolutely dangerous. But let's talk about the correlation to the U.S. economy as Americans' rising inflation concerns threaten to undo soft landing. So we look to China, and what do we see in the banking system? A rising cost of capital, a slowdown in demand for lending, and historically, particularly when we look at U.S. data, it tells us we're headed into a recession. Now let's put this in perspective from the U.S. household budget. Their costs are going up, and their incomes are not going up. So you can see U.S. households headed right into a recession as well, as consumer inflation expectations have been rising for the last month or two across several reports. In fact, some surveys point to businesses anticipating higher prices as well. And if those expectations become reality, it could prove catastrophic for the Fed's attempt to stabilize prices without causing recession. And ultimately, it doesn't matter if you think that or if you're a Democrat or Republican. It affects how you're actually consuming or asking for wage increases and things of that nature. It's still going to potentially affect inflation, and I agree with that. It's not a matter of political party, because we see that in the reports. The Democrats think inflation is going to surge higher. Republicans think it's going to moderate some. But in the end of the day, it doesn't matter what people think. It matters what people do, because if we do indeed see prices go up and we see earnings go down, well, it doesn't matter. People will be unable to spend more. And we can go right back to the late 1980s, and what do we see? Inflation in blue rising. That's the consumer price index. And what do we see in red? Total household income. That's average hourly earnings multiplied by average weekly hours of production of non-supervisory employees. Is decelerating right into a recession. You see that combination happen right around 2000. Again, inflation heads higher, wage growth stalls out, and then it rolls over. And next thing you know, right in the dot-com bubble. Again, it happens. Global financial crisis, inflation surging due to energy costs, total incomes heading lower, right into a financial crisis. Again, it makes perfect sense. If people can't afford higher prices, they can't consume more. And next thing you know, that lack of demand backfeeds right through the economy. And what are we expecting now? We hear from the manufacturing and services sector that inflation set to go higher. And at the same time, we see average weekly hours heading down, suggesting that incomes in the U.S. about to plunge against higher prices. This is, again, you look at the relationship between China's banks and the U.S. economy. They're dealing with higher costs of capital. We're dealing with higher costs of goods. They're dealing with a slowdown in demand for lending, and we're going to deal with a slowdown of demand from U.S. consumers. And new tariffs will seem to be playing the biggest role of inflation. Expectations are being announced almost every week. Other policies, including deregulation, increased deportations, and broader tax cuts, could help reaccelerate inflation. The increase in expectations also comes alongside rising concerns about the growth outlook, and that's exactly what we're seeing in the bond market. It's telling us that growth and inflation expectations are coming down as U.S. Treasury rally sends yields back below 4% as inflation cools, and the Fed thinks they have no reason to cut. But when we look at this slide, it makes perfect sense. As we look at the consumer price index against the unemployment rate, CPI in blue, unemployment rate in red. So when you see rising inflation and rising unemployment, what do you see in 10-year Treasury yields shown in green? They head lower. You see that happen right around the early 1990s. You see it happen going into the dot-com bubble, throughout the financial crisis. And right now, everybody thinks U.S. rates need to head higher. But if we see inflation turn up and the unemployment rate turn up, look for yields to come crashing down. And you can make money trading equities, bonds, currencies, and commodities. And that's exactly what we do for our subscribers each and every day. Let's talk about our big trade. Now, if you want to find out what this is, well, you have to subscribe to find out. But let's check it out because we put this trade on the books back on the 21st and 24th. That trade up for Momentum Timer Pro subscribers, 5.8%. For a CTA Timer Pro, up 5.07%. And this was the notes we gave to our subscribers in both reports. Let's talk about that trade because we told them to buy right here, and then it gapped up, and now is looking to take off and head even higher. And it's not too late. You can jump in on this or our next big trade. Now, what do we do every day? We scan the markets. We look at machine positioning. This is called our CTA Timer Pro. Now, why do we care about machine positioning? Because machines move hundreds of billions of dollars when they need to buy something, and we look to position our subscribers ahead of machine buying and try to get them out before machine selling. But what about momentum? Well, we have a report for that. A lot of people like to trade those things like the RSI and the MACD, but they struggle to do it because they don't realize it's all about the trend. You need to pair momentum with a trend, and we do that and do it very well. It's called a Momentum Timer Pro. But here's the best part. We put all the notes underneath. You don't even have to read the reports, but you get the reports every day, the tradable signals. I go through all the trades and tell you these are the best ones. We back tested our reports to validate them. We give you risk control levels, full tracking of trades in return, a weekly update, a disclosure of how I'm trading my own reports. And we're so confident you can make money trading our reports, we give you a 30-day free trial. That's right, 30 days on me. Use the links in the description below. You be sure to hit those coupon codes for that 30-day free trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.